On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Morning, team. Hope you're all well. That's another week down. It was another very eventful one. I'll do my best to bring you up to speed and wrap all of that up. Then we will turn our attention to what you need to know in the days ahead. Global share markets. The US S&P 500 fell another 0.8% last week. Investors still rotating out of those high-flying sectors and into parts of the market that look better value that have lagged over the last little while. So the so-called Magnificent Seven, that group of stocks, those seven heavyweights, they fell another 3.4% last week, and they've now declined about 11% from their peak earlier this month. They've still done exceptionally well over the last 18 months, but they have come off the boil lately as investors have been taking profits and putting their money into some of the parts of the market that look more attractive, that haven't run quite as hard. So if you exclude the Magnificent Seven, the US market was actually up slightly last week, and it's only 1.7% off its highs. So it has been a little bit lopsided. A lot of the weakness that you've seen of late has been centered on those stocks that have been such great performers for the last 12 months, 18 months. People are now selling those ones and moving elsewhere. So you've got to bear that in mind. Japanese shares also suffered quite a sharp sell-off last week. The yen has been strengthening and investors have been positioning for the potential for another interest rate hike later this week. We'll talk about that shortly, but the Topix index in Japan fell 5.6% last week, which is its worst week since 2020. Important to note that the Japanese market is still up 14.1% this year, and last year it was up more than 25%. So yes, it's off just recently, but it still had a fantastic run. So I think we'll forgive the Japanese market for having a little bit of weakness creep in. The FTSE 100 in the UK was one of the stronger global indices. It was up 1.6%. European shares were also slightly higher, up 0.3%, while emerging market equities fell 1.6%. Closer to home, the Australian ASX 200 was down 0.6%, while the local market again bucked the global trend and eked out a small gain. So with just 3 trading days to go, the local NZX 50 index is up 5.4% this month. Only 3 more days of July, but the local market's up more than 5%. So it's on pace for its strongest month in almost 2 years. So it's had a great run just over the last few weeks. Interest rates slipped back slightly in most places. US interest rates saw the 2-year Treasury yield finish at 4.4%, so that's down a little bit. The 10-year US Treasury yield marginally lower too, at 4.2%. Here in New Zealand, our 5-year swap rate, which is a wholesale interest rate, fell another 11 basis points, so it's down at 3.86% now. That's the lowest we've seen since August 2022, so almost 2 years ago. And it's almost a full 1% lower than it was 3 months ago. And the market now sees 0.75% OCR cuts this year. That would see the OCR end the year at 4.75%. And current market pricing now implies a 65% chance that the first move will come at the August meeting, which takes place in just over 2 weeks' time. You've got most of the economists saying it'll be November, maybe it'll be October. Financial markets think that in just over a fortnight, there's a good chance you might see the first OCR cut this cycle. So if you want to know more about that, the OCR, what might happen, when it might happen, what it means for borrowers, savers, investors, I did write a report on this last week and I recorded a podcast episode. So talk to your advisor, check out our blog, or go back through wherever you get your podcasts, wherever you're looking for this, and check that one out if you missed it. I won't dwell on it anymore. But we did see the New Zealand dollar respond as well to what you've seen in interest rate markets, what you've seen with the share market, and what you've seen with those OCR expectations, because the currency has been quite a bit weaker this month. We're down 3.6% in July on a trade weighted basis. So that's the basket of currencies we measure ourselves against, down 3.6% at the lowest level since early November last year. So to put that in perspective and hopefully explain why that should matter for you, against the Aussie dollar, we're down 1.5% this month. Against the US dollar, we're down more than 3%, down just under 59 cents now. Against the pound, we're off 5% this month. Against the euro, we're off 4.5% this month. So some big declines for the Kiwi dollar. Now, if you're an exporter, that will be good news because you're more competitive. If you're an importer, then maybe not so good news because things you buy and consume from overseas will be more expensive. But for investors, it's been a boost for most investors. Most of the time, New Zealand investors buy international shares, overseas shares. They're not hedging the currency. Sometimes they'll hedge a part of it, but most people either are fully unhedged or partly unhedged, which means they're taking on that currency exposure. And what that means is that when the New Zealand dollar is weakening, you get a boost to your returns. It supercharges your returns. I'll give you an example. The UK market up 1.5% in July, but because the Kiwi dollar is down 5% against the pound, in New Zealand dollar terms, your return is closer to 7%, 6.5%, 7% from your UK share. And that's been the case across the board. The returns from non-New Zealand shares, international shares, have been boosted by those currency moves. So that's been quite pleasing lately. Right, turning our attention to some of the key events last week, and there weren't a whole lot of releases. We did see flash PMIs for July, purchasing managers indices, which are essentially activity indicators. A bit of mixed feedback about the state of the global economy as the third quarter starts. In Australia, the composite PMI was softer than expected. That hit a 6-month low. In contrast, the Japanese measure jumped. It was ahead of forecasts and benefited from a surge in services sector activity in Japan. In Europe, activity stalled. It fell to basically the break-even level, while the UK measure actually looked quite good and it rose. So some ups and downs there. The shining light was the US, which still looks to be one of the strongest economies in the world. We got some good GDP data out of the US last week too. But the composite PMI hit a very strong 55. That's well above the break-even level, which is 50. It's actually the highest in more than 2 years. And it really does tell us that the US is looking like it's in that Goldilocks zone. You've got robust growth accompanied by further evidence of moderating inflation. Inflation indicators in this PMI release pointed to average selling prices for goods and services falling to a level that is consistent with the Federal Reserve's target of 2%. So that was quite a positive. While we're talking inflation and while we're focused on the US, we also got the PCE inflation index for June last week. PCE stands for Personal Consumption Expenditures, and this is important because it's the Federal Reserve's preferred inflation measure. Good news, another tame inflation reading in line with expectations, no nasty surprises. We saw the PCE index for June rise to 2.5% at an annual level. That's the lowest since March 2021, in line with forecasts. Core PCE increased at 2.6% on an annual basis. That was the same as a month earlier, so no change there, been heading in the right direction and in line with market forecasts. If you look at the annualized 3-month average inflation rate, that's fallen to just 1.6% at the headline level and 2.3% for the core measure. So just looking at the last 3 months gives you a better feel for where inflation is at the moment, rather than looking at that year-on-year measure, which picks up all sorts of things that have happened over the last 12 months. And some of those things have changed compared to what we're seeing today. So that is interesting too, and markets were comforted by that. Looking ahead to the coming week, and we'll start here at home, it's a relatively quiet week in terms of economic releases. I think the key one will be the ANZ Business Outlook, which is due at 1 o'clock on Wednesday. This will cover the month of July. Headline confidence lately has been falling. We've seen it falling for 5 months in a row, and it's back at the lowest levels since September last year. More pleasingly, inflation indicators have been slowing as hoped. And I think this will be a focal point this week as everyone looks ahead to that next Reserve Bank meeting. Last month in the ANZ survey, we saw inflation expectations fall from 3.6 to 3.5%, and the proportion of firms that are expecting to raise prices fell to 35.3%, which is the lowest since January 2021. And that's a really important and accurate leading indicator for where inflation is going. So that will be in focus on Wednesday afternoon. Inflation will also be in focus across the Tasman. We'll get the Consumer Price Index for the June 2024 quarter. That is out on Wednesday afternoon as well. And this will be important because markets are toying with the idea of more rate hikes in Australia. And here in New Zealand, as is the case in the United States and the UK, and it's already happening in Europe, we're all talking about interest rates coming down. But the Reserve Bank of Australia might need to increase interest rates further from where they're at today. I'm hopeful they won't, but some people think they will, and markets are pricing about a 25% chance of another rate hike from the RBA. So this week's Consumer Price Index figures will add another piece of evidence to that puzzle and will give us a bit more of a steer on whether the RBA might need to do some more work or whether they've done enough. So that will be the key release across the Tasman. While we're still talking central banks, there'll be 3 important central bank meetings this week. And the first will be the Bank of Japan, the BOJ, on Wednesday afternoon. This will be an interesting one. We saw the first interest rate hike in 17 years back in March from the Bank of Japan, and that ended 8 years of negative interest rates. So they're ever so slightly in positive territory now, and they'll keep moving further into positive territory. The next move could come as soon as this week. However, weakness in consumer spending could complicate that decision. I know there are some officials that are a little bit nervous and think it could be better to skip a hike this time and then act further down the track. So we'll wait and see. It could impact financial markets. It could impact the currency because we just did talk about the Japanese share market, which had a rough week last week. We've also seen big moves in the yen lately. The yen fell to the lowest level against the US dollar that we've seen since the 1980s about a month ago, but it's rebounded since then and it's now sitting at a 3-month high. So if the BOJ doesn't hike interest rates, you could see some of that reverse. So that will be a really interesting one to watch Wednesday afternoon. The next morning, Thursday morning here in New Zealand, we will get the main event, and that will be the Federal Reserve. Its decision will be released at 6 a.m. on Thursday here in New Zealand. Then we'll get a press conference from Chair Jerome Powell. There won't be any new forecast this time around, so it'll just be the statement and then the press conference. They won't make a move this week. The Fed funds rate is sitting at 5.5% at the moment, the same as the Reserve Bank's OCR actually. That's the highest we've seen in the US since 2001, and it's been at that level since July last year. However, the next move will be down, and it's highly unlikely that won't come this week, but markets do see a cut coming at the next meeting, which is in September, and they see 2, possibly 3 cuts in total before the end of this year, which is about the same as the Reserve Bank, isn't it? So this week will be interesting just to see whether the Fed is a bit clearer about its plans. Markets already pricing a move in September. Will the Fed give any endorsement or confirmation that that is the case? That will be the main event, 6 a.m. Thursday morning here in NZ. Third one will be the Bank of England. They meet on Thursday and it will be in the evening for the Bank of England. This one could go either way. Markets really do see a 50-50 chance of an interest rate cut from the Bank of England. The Bank of England policy rate is sitting at 5.25. That's the highest since 2008. Last time they met in June, they elected to leave it be, but it wasn't a unanimous decision. 2 members voted to reduce it, but another 7 voted in favour of leaving it unchanged. So they are moving towards that eventual cut. It could come this week, or it could come in August. The UK has made pretty good progress on inflation. Their CPI is tracking at about 2%. That's where it's been for the last 2 months, which is exactly in line with their target and the lowest that we've seen in 3 years. So good chance you might see a Bank of England cut this week. If you don't get it this week, it looks almost certain that you will see a move in September. So those are the three big central bank meetings for the week. Also a busy one when it comes to economic releases, particularly in the United States. We will have the ISM Manufacturing Index, the Institute of Supply Management Index, and the jobs report. Both of them will cover the month of July. These are two very high profile economic indicators, so people watch them very closely. The ISM index is out on Thursday, and then the jobs report follows a day later on Friday. That's US time, so we won't get the jobs report until Saturday here in New Zealand. Last month's manufacturing ISM slipped to a 4-month low, and its services counterpart suffered the biggest fall in 18 months. So they both looked quite weak, the services ISM and the manufacturing ISM. We won't get the services one until next week, but that manufacturing one that we get on Thursday will be very interesting to watch. The jobs report, probably even bigger. The labour market is really important to the Federal Reserve. It's something they watch closely. And the labour market is also really important in terms of the path of the economy and monitoring any recessionary risks that might be on the horizon. The June jobs report was pretty much in line with expectations, so it was good. It was comforting, no nasty surprises. The unemployment rate did increase a little bit. It went up from 4.0 to 4.1. So unemployment in the US is actually the highest we've seen since November 2021. But more importantly, it hasn't been pushing higher at a fast pace. It's only been steadily creeping higher. So that's almost more important, the pace that it goes up rather than where it goes to. You don't want it to go too high, obviously, but those steady moves are what you want to see. You don't want it to jump dramatically up between 1 month to the next. So that will be closely watched on Friday, and that will round out a relatively busy week of US economic releases. The international quarterly reporting season will also continue this week, and this will be really interesting. You've got 170 S&P 500 companies that are scheduled to announce results from a range of different sectors, but 4 of the big tech stocks are part of that group. So we've got Microsoft on Tuesday, you've got Meta, which is Facebook, on Wednesday, and then on Thursday, you've got Amazon and Apple. That's all US time, so you often see them a day later here in New Zealand. But those 4 will be very much in focus because you have seen that weakness across the tech sector, across the Magnificent Seven of late. We had results from Alphabet, which is Google, last week, and we had Tesla. Both a little disappointing. Both were sold off. So I think people will be watching Microsoft, Meta, Amazon, and Apple very closely. It's not just big tech that we'll be watching. There are lots of companies due to report results this week from right across the world, across a range of sectors. McDonald's, Diageo, Procter and Gamble, ExxonMobil, some of the other names. So it will be really interesting. So far, about 40% of the S&P 500 has reported results, and almost 80% of companies so far have beaten earnings estimates, which isn't bad. For the June quarter overall, in aggregate, the earnings growth rate is tracking at about 9.8% relative to the same quarter a year ago, which is quite healthy. That's actually the highest we've seen since December 2021, and it's the 4th consecutive quarter of earnings growth. There's a few corporate releases to watch across New Zealand and Australia too. Here at home, we'll have a couple of AGMs. Ryman Healthcare is probably the one that will get the most attention. That is on Thursday, Ryman's annual meeting. They've obviously had a very strong run of late, as has that whole sector on the back of corporate activity. So the market will surely be very interested in what the Ryman team has to say and whether that share price rebound we've seen over the last month or so is justified. Across the Tasman, a couple of big results. Rio Tinto will release their half-year result on Wednesday, and we've got a quarterly result from ResMed on Friday. So certainly lots to watch. Also plenty on the political front. It's been a very busy period in the US in particular on the political front. We've obviously seen Joe Biden step aside. Kamala Harris, the current vice president, seemingly looks to be a shoo-in as the Democratic nominee for this year's election. And we've had news recently that JD Vance will be Trump's running mate for his campaign. So I won't delve into that too much deeper, but I am planning on writing and recording something on that next week. So keep an eye out for a new episode with a bit of an update of where we're at with the US election, with politics, and whether some of this news and these developments changes the landscape for how things might develop heading towards November. Right, I know that was a lot to cover, but if you've stuck with me for the whole episode, then well done. Thank you for listening, and I hope that was useful to you. We'll talk again soon.
For more insights, visit craigsip.com.